Hello, everyone. My name is Parsa Vahid, President and owner of Strand Life Financial Group. We are a financial planning firm out in Southern California, dealing with financial planning, wealth management, estate planning, and retirement planning. Today, I want to talk to you guys about a subject that has recently become very interesting to me. A few years back, I was introduced to the concept of a deferred sales trust. I had a client reach out to me. He was looking to sell his business and was looking to avoid paying those capital gains taxes. So we looked into the deferred sales trust. That client actually ended up passing on to the business to his children. And so I just kind of put the concept in the back of my mind, never really thought about it until recently. Fast forward to about 2 months ago, another client reached out, and this client was a real estate investor, heavily involved in real estate out in the Southern California market, and said, Parsa, I'm sick and tired of real estate. I think I'm getting a fantastic deal for this sale of this property, this investment property I'm dealing with. And I just don't want to get back into another property using the 1031 exchange. I've scoured the market, trying to find another deal. Unfortunately, there's really nothing out there that kind of fits my needs. What are my options? So we kind of discussed the two options that I thought would be suitable for him. One was a DST, a Delaware Statutory Trust, and we'll talk about that in another video. The main drawback to that is that he would have lost liquidity, and he just wanted the ability to get back in real estate if another opportunity presented itself. So I told him about another concept that I heard about a few years ago known as a Deferred Sales Trust. I wasn't very well versed in it, so I decided to reach out to the expert, and actually he's here with us, upcoming guest, Brett Swarts of Capital Gains Tax Solutions. So us three, we hopped on a call, took about 45 minutes. Brett walked my client through the ins and outs of the product, the structure, I should say, and it really just made perfect sense for my real estate client. So I wanted to just host a little meeting right here and discuss this with Brett, who is the expert. I think a lot of people don't know about this structure. Me being in finance wasn't too well versed in it, and I'm sure most of the public isn't. So I find this opportunity to educate people and have them just learn about the benefits, the potential benefits of the structure. So without further ado, I want to bring on President of Capital Gains Tax Solutions, Mr. Brett Swarts. Brett?
Parsa, hey, thanks for having me. A pleasure to be here. Looking forward to diving into the Deferred Sales Trust.
Absolutely. Thanks so much. So Brett, just tell us a little bit, actually go into as much detail as you think is appropriate about how this works, who this works for, some of the benefits, and just assume that a lot of the listeners may not know much about what a 1031 exchange is, what appreciated asset is, capital gains. Just try to dumb it down as much as possible for us.
Absolutely. So most commercial real estate owners, business owners, and high-end primary homeowners, they struggle with capital gains tax, somewhere between 30 and 50% of their gain when they go to sell their highly appreciated assets. And so we use a deferred sales trust to give them tax deferral, liquidity, diversification, and like you said in the intro, the ability to eliminate the need for the 1031 exchange so they can create and preserve more wealth. And that's really at the heart of what we're about, is helping people escape feeling trapped and having some options for how they retire or how much time and energy is spent towards those types of assets. So the main thing to look at is what we call the big shift that's happening right now in the world, and this is the according to the American Bankers Association, there's about $17 trillion that's passing from one generation to the next in the next 20 years, and this is known as the baby boomers, and it's the largest wealth transfer in the history of the world, and it's happening right now. In fact, there's about 77 million baby boomers in the U.S. alone, and every day about 10,000 of them are turning 65. And so when you look at some of those numbers, what are they faced with? Well, they're faced with highly appreciated assets that they've worked for 20, 30, 40 years to accumulate, and they're looking to retire from the toilets, the trash, the liability, and again have some more liquidity and perhaps just preserve their wealth versus the creation mode. And then you couple that with what happened in 2008, where a lot of people overpaid for properties before the crash, 05, 06, via the 1031 exchange. And we call this the perfect storm, where instead of having to overpay for a property, you can maybe never buy a property again, or buy properties whenever you want to. So it just gives you a lot more flexibility and a lot more options. And we can customize a wealth plan based upon the client's needs.
Yeah, absolutely. Something that I know that you spoke to my client, we were on that call, something that really popped out to him was, why don't more people know about this? This kind of fits my exact needs. So, and I didn't have an answer for him. I was introduced to this just because I'm in the business of financial planning. So I was introduced to this a few years ago, but I really didn't know the ins and outs. So can you just touch on the IRS component and how this actually is a viable option for investors?
Absolutely. So the first most important question, if you're facing any tax deferral strategy, especially if it's new, you want to ask a series of questions, and I'll give you a few here. The first one is, well, what's the IRC tax code that this is based upon? And this is known as IRC Section 453, which is known as an installment sale. And an installment sale, or seller carryback, goes back to the 1920s. That's when this law was enacted in the U.S. And since then, it's been used, thousands and thousands, maybe millions of times over the course of history. And it's very well known, actually, for CPAs. It's very well known for real estate folks, even business owners who are selling their business, and they might carry paper. And so we'll walk through a little example here. Imagine Parsha was going to sell his $10 million business, and let's imagine you owned it free and clear, and let's imagine you had a $4 million tax liability, meaning you had a zero basis, you owned it free and clear. So if you were to sell today, you would owe all that tax. Well, you can do a seller carryback. It's called traditional seller carryback, IRC 453, or you can actually carry paper. So I could give you, let's say, a down payment of $2 million, and you could carry a note for $8 million. And that's very well known. And because you carried paper, you don't owe tax on what you haven't received yet. But on the $2 million you have received, you'll owe tax on that. So that's the foundation of the structure. And the IRS does this, or puts these legal loopholes in place to actually spur the economy. It's the study of macroeconomics. If I can keep the money flowing and keeping money in the economy, in stocks, bonds, mutual funds, in real estate, it actually is going to create more jobs, and in turn going to create more tax revenue. So one of the biggest misconceptions is, well, am I doing something illegal here or something wrong? No. This is actually, the IRS wants people to sell and transact. They get the commissions when the property sells or the business sells. They get the new property taxes based upon the new bases. And typically that money, they know if they create the legal loopholes, will flow to something else. So again, the first question is, what is the tax code? The second question you want to ask is, okay, that's great. That's the tax code, but you guys are doing something a little bit different, and we are. We're just inserting this trust into the transaction, and this trust is the one who's actually going to buy your position. So Parsha, imagine this trust, this business trust we create. It's a deferred sales trust. It's actually going to buy your position for $10 million. And we're going to ask that cash buyer to come with the full $10 million, meaning get the financing by himself, and not ask you to be the bank. And that scenario, what's really nice is the full cash goes into the trust. And since you receive a zero down payment, you haven't received any tax or any cash. Therefore, you don't owe any tax today. It's all in a deferral state. And the buyer takes the title the same way. And so the net result of it is the trust bought for $10 million, sold for $10 million. And because of that, the trust has a zero gain. And on your side, since you received a zero down payment in exchange for a note, and this is the key here, you're becoming the lender, just like you were becoming the lender on the traditional installment sale. The difference is now you're becoming 100% of the lender, okay? Therefore, you're 100% tax deferred. And but the key is the collateral now can be very, very flexible. At this point, everything closes. The buyer takes the property or the business, and the funds are sitting in the trust. And now you can invest into stocks, bonds, mutual funds, or real estate of your choosing, but without any restrictions in regards to timing, meaning you may never go back into real estate. So that's really the second point here, that it's just an installment sale. We're using it based upon the IRS tax code, but we are professionals at it, which leads into the third question you want to ask somebody. Well, how many of these specialized installment sales have you done? And the answer is thousands, okay? Just over 2,000, nearing 3,000 transactions. The next thing you want to ask is, well, how long have you been doing it? The answer is 24 years with the Deferred Sales Trust tax attorneys, and also thousands of business professionals across the U.S. that we partner with. And the next most important question is, well, how many of these have been challenged by the IRS? Because I want to make sure that, you know, whatever transaction you're getting into has some legs to stand behind in case the IRS challenges. And the answer is 14 times. And of those 14 challenges, 12 of those were all of them were no change audits, but 12 of them were random audits, meaning it wasn't triggered by the IRS looking at the DST. It was triggered just because it was a high net worth individual. And so as a part of that, they said, what is this? And they said, oh, well, it's just an installment sale. You guys are being creative on how you're applying the law, but you're just doing an installment sale. The last two were formal audits where they looked at the entire structure, sat down with the tax attorneys. They sent everything back to Washington, D.C. So the IRS knows us, and on all of those were no change audits, not one single issue. And that's really important because whatever tax strategy you're looking at, you want to make sure that A, it has a long track record, B, it actually has a track record with the IRS, and C, the representatives who are presenting this structure have actually defended their own clients with the IRS and have won, right? And by won, meaning not one single issue with the IRS.
Yeah, absolutely. And just as an aside, when we hopped off the call, you know, my client and I continued the conversation on a separate call, and he asked, you know, what if I do want to do a 1031 exchange? I've got 6 months. Realistically, I've got 45 days to identify a new property. What if I start looking, kind of find an opportunity, but that doesn't pan out? Can I then do the deferred sales trust, or do I have to commit now? And then I reached back out to you and you said, no, absolutely. That's really what it's designed for. It's kind of if you have a failed 1031, here's a perfect opportunity to use a deferred sales trust.
Great point. Yeah. So the 1031 exchange, again, we like the 1031 exchange if you can find a property which makes sense for you. And if you still want to be in the toilets, trash management, and headaches that those real estate oftentimes produce. So assuming you want to still go for a property, great, we're for you there. In fact, that's my background. I started at Marcus & Millichap in 2006. And for your listeners who don't know what that is, that's one of the largest investment real estate brokerage firm in the nation. And so the focus is on investment real estate. And I've helped people do countless 1031 exchanges. I've sold nearly $90 million in commercial real estate over the years, and senior housing, multifamily, land, office, retail. And as a part of that, we learned about the 1031 exchange immediately. That was the best tool we had at the time before we learned about the Deferred Sales Trust. And so we'd help people do 1031 exchanges. But the 1031 exchanges have a few challenges inherently. The first one, like you mentioned, is the 45 days to identify and 180 days to actually close. And the challenge here is it creates this pressure situation where too often people are overpaying because they feel they have to buy something because they have to defer this tax. And so I saw it happen too many times, and this is actually the heart of why we started this company, to give people freedom from capital gains tax as well as the 1031 exchange, not having to overpay for properties. And the second thing it does is it creates a situation where you have to take on equal or greater value to perfect the exchange 100% of the tax deferral, meaning oftentimes you have to take on equal or greater debt. So let's just say you had a $5 million sale and you had $3 million of debt on the property. Well, you need to buy something $5 million or greater, but then take on you're probably going to take on at least $3 million more debt, but oftentimes you end up buying maybe a $6 or $7 million deal, and now you have all this debt, and now you've overpaid, and it becomes the perfect storm for losing all of your equity. And that's exactly what happened in 2008. I saw family and friends and clients lose everything because they felt pressured by these time periods to have to overpay for property, take on even more debt, and then when the music stopped or the deals didn't work out or the economy shifted, they had to fight with the banks and some of them lost everything. And so we don't like the fact that it puts pressure on clients and you have to overpay. But if you can find a property and you can take on what's called smart debt, and we define smart debt is finding deals that are value add, that have some forced appreciation opportunity, that maybe you can have a low price per square foot. And if you can find that, great. We're in California, so we know it's very difficult difficult to find those right now. And but yes, so then you can go shopping, right? And go shopping for your property. Make sure you use a qualified intermediary who's going to allow both of them. That's very important. And we have those partnerships with companies, but not all QI companies are for you on this, because why? They're incentivized for you to keep doing 1031 exchanges. So they're not necessarily going to tell you about it, which kind of leads to your initial question. Why don't more people know about it? Well, commercial real estate brokers and 1031 companies are not in the deferred sales trust business. They're in the 1031 exchange business. And 1031 exchange companies make money when the funds go into their QI, into their company, and they earn interest off of that for the 6-month period or so that the funds are there. And if they go to the deferred sales trust, all of a sudden, the funds can be in stocks, bonds, mutual funds. It's no longer in real estate. So they're not necessarily want to tell you about this, right? They're not in the business. They're not making money on this. Although we do have qualified intermediaries who give both options and see it as a win-win, because they actually win more business when you add more value to the client. So that being said, make sure you get with us before you close your property and before you close you choose a 1031 qualified intermediary, so that you have both options. So that'd be the next thing. The last one would be the new depreciation schedule. So with the 1031 exchange, one of the challenges is the depreciation schedule travels, and depreciation is the number one reason for owning investment real estate, I think, among a couple others, because it offsets the income that's coming in. Okay, so if you bring in $100,000 of revenue or net operating income, you may be able to offset that with $10, $20, $30,000 of depreciation in that given year, and therefore you only pay tax, let's just say, on 70 or 80,000. However, eventually, if you own properties long enough, for example, multifamily, 27 and a half years, that depreciation schedule goes down to zero. Okay, and if you've done enough 1031 exchanges, it just, the only more you get is on the bigger property you buy. And so again, you get caught kind of in the trap of having to overpay or buy bigger properties. So the solution is to get a new depreciation schedule. Well, how do you do that? Well, you don't do that via 1031 exchange. You actually do that through the Deferred Sales Trust. So your clients can sell today, get tax deferred, and pay off all their debt, put it into the Deferred Sales Trust, get in a conservative portfolio with you, Parsa, for as long as they want. And let's just say 2, 3, 4, 5 years down the road, the market finally shifts, and prices that used to be, let's say, let's call it a $10 million property is now worth 8.5. Now they can use those funds in the trust that have been safe, liquid, diversified. Then they can use that to go buy that property with debt or without debt, depending on how much they have in the trust. And then they get a brand new depreciation schedule. And we call that optimal timing. And we call that taking on smart debt when the deals make sense, not taking on what we call dumb debt by overpaying for properties via the 1031 exchange.
Yeah, I think you hit on such an important point, because my client actually experienced that in 2007, had to 1031 or thought he had to 1031, wasn't exposed to the Deferred Sales Trust back then, and just got wiped out with multiple real estate properties. And so that scarred him. And I'm sure many million other people have experienced that if they've been in real estate long enough. And so one thing that really jumped out at him is, he can eventually get back into real estate, whether it's 8 months down the line or 5 years down the line. He can be patient and strategically get back into real estate using the Deferred Sales Trust. And I think that's a common misconception as well, is when you are in the Deferred Sales Trust, what can you do with the money? So if you can just touch on that point as well real quick.
Right. Absolutely. And this is the thought, just before we lose that thought. Our parents taught us to sell high and buy low, not sell high and buy higher 180 days later. And that's kind of the essence of what I've seen with the 1031 exchange. Whereas the Deferred Sales Trust, by the way, not to be confused with the Delaware Statutory Trust, a Delaware Statutory Trust, they're both DSTs. And the Delaware is just another form of a 1031 with a big company, big corporation that you can exchange into, but oftentimes no liquidity. You're also buying high. It's not, we think it's just not a good time to buy real estate. So the first thing, the premise is always, is it a good time to buy real estate? Yes or no. Can you find a deal? Yes or no. And right now, again, our thought, especially in California, is it's a great time to sell. It's a terrible time to buy. So assuming you sell high, You pay off all your debt, you move it into the Deferred Sales Trust. Now, what can you invest into? Where can the funds be invested? And this is the best, I think the best part is, one, remember, you're out of debt. You paid off all your debt. There's no debt replacement requirement. If you had debt on a property, that debt gets paid off at closing to the bank, and only the net proceeds go into the bank. So now they're in there. Where can you invest them? Well, first of all, they're invested where you want them, based upon your own risk tolerance, okay? And you would work with Parsha to establish that allocation and that risk tolerance, and that is where the funds are invested. And so let's just use the scenario again of a $10 million property, and you would have paid $4 million in tax. And so instead of putting $6 million with Parsha, now you have $10 million minus some fees on the Deferred Sales Trust, but a much higher amount. And all of that amount is sitting in the trust. And you can put it into stocks, bonds, mutual funds. You can put it in ETFs. You can put it in insurance products. You don't have to have like kind, okay? Like, so in real estate, you have to trade investment real estate for like kind investment real estate. Ours there's no like kind rules. And why is that? Well, we're a separate tax code. Remember, IRC 453 versus IRC 1031. Right? Those are two different tax codes. They both give tax deferral. By the way, the 1031 exchange has been around really since kind of the 1950s, but really didn't become popular until the 80s, 90s, and really the 2000s. Some people still don't know about the 1031 exchange. They're still learning about it. We've been around since the 1920s as far as the tax code, but we've been doing it for 24 years. So we're still teaching a lot of people. It's also a proprietary structure. We might as well touch on this now too, to answer your initial question of why don't people know about it. It's a proprietary structure, and it takes a team of professionals to execute. There's certain guardrails we need to stay in line, right? And as long as we do that, we can keep the tax deferred, such as you cannot invest into a primary home. Okay, so the funds can't go into the trust and then you go buy a primary home with the funds. That would be considered actual receipt of the funds. It's personal property, such even like a car, or use it for travel. You can't use the funds to basically do personal stuff. And the reason is the government wants to incentivize business growth, right? It doesn't want to incentivize just pleasure, if that makes sense. It's more they want the economy to grow. So the answer to your question is, what better way to ask it would be, what can't you invest in? Well, you can't go into primary home. Okay. Also, we like to stay within the U.S. In investment real estate, if you're going to do an alternative investment or a business. But as far as if it trades on the New York Stock Exchange, great. You know, that's all insurance products, ETFs, stocks, bonds, mutual funds. All of those things are available and flexible with the Deferred Sales Trust.
Great. And another component to this that really jumped out at me was for business owners. As you know, I'm a business owner. You're a business owner. Coincidentally, I was recently approached by a larger corporation that wanted to potentially buy Strand Life Financial Group. Didn't make sense for me, but eventually that is the plan for my practice. Whether it's 20 or 30 years down the line, we'll see. But I know I would be absolutely hammered if I were to sell my company, just like many other business owners. I've got clients who own law practices, medical practices, entrepreneurs, and they have no basis. So their sale of their company is just going to equate to 40%, sometimes closer to 50% of the sales price going to the government. And so the beauty of this structure is that it allows them to defer those capital gains taxes using the structure. So I personally, it really jumped out at me, and I know for many of my clients who are also business owners, this should be something that they should always have in their back pocket. And that's really the purpose of this meeting today. Is I just wanted to get the word out and educate people that this structure exists. It may not work for you today. You may not need it today, to be quite frank, but to always have this in the back of your mind that when you do want to sell, whether it's appreciated real estate or your business in and of itself, you've got this deferred sales trust as a strategy to implement into your wealth plan. So
absolutely. Touch on a couple of things. We just actually, one of the deals was with an LPL financial advisor, one of the largest financial advising, overall, I think, companies in the U.S. And he had a practice for 25 years, same thing, and he had never heard of it. And he's very, very smart and looked at everything and vetted everything, and he did it for his practice. We also did a 20 $5+ million business sale for a real estate company that was selling real estate, and they used it. And it works for dentists and veterinarians and tech companies and truck companies. You name it, we've done. Just optometrists, we've done it just about everything you can think of. It works for high-end cars. It works for collectibles. It works for artwork, car dealerships. We've done all of those. Self-storage, multifamily, any kind of commercial real estate. Also high-end primary homes. And actually a recent deal was in Newport Beach, kind of near where you're at, Marcia. And it was a $26 million home. See, this couple was getting a divorce, and they didn't qualify for a 1031 exchange, which is also good to note that a 1031 exchange only works for investment real estate. They've actually restricted the law even more recently. So a 1031 for a business owner is out the door. It's out the door for a primary homeowner, but it does work for investment real estate. So, but most business owners don't know that, and most primary homeowners don't know that, and so that's very important to mention. And the other thing we can touch on too, back to that Newport Beach. So we saved them $6 million in capital gains tax, okay? Above and beyond their 121 exclusion, which is if you lived there 2 of the last 5 years, you have $250,000 excluded on your capital gains tax if you're single, $500 if you're married. But above and beyond that, they owed $6 million. And so they were able to sell their house, defer $6 million, additional $6 million, have all the proceeds go into the trust, and now they can live off of all of that. But more so than that, just live off that wealth, they can also give more, which is at the heart of what we're about. We want to be able to unlock this illiquid capital. We like a lot of our clients say we felt real estate rich and cash flow poor, or we felt business rich and cash flow poor, right? Or a primary home rich but cash flow poor. And they're able to unlock this capital that was trapped there and move it into an income stream. Now, this income stream, we might as well touch on this now, is typically after fees earning about 6.5% depending on your risk tolerance, but it goes into, let's say, stocks, bonds, and mutual funds, and we map out, Parsha and you and us, we map out a plan. It's typically a 10-year note because you became the lender, and you start receiving interest payments on what it earned. And so let's just say it was 10 million and it was earning, let's say, 8%. You live off that 8%, minus some fees, which would be about 6.5%. You live off of that amount. Well, you'll pay ordinary income tax on that, but the rest of that 10 million is in a deferral state. And that's the power of the Deferred Sales Trust, to find what your tax liability is, and now we can have an income stream coming off of it, and now you can maybe give more to charity, but you don't have to give to charity. That's the other thing we might as well compare right now too, is the CRT. We're kind of like the charitable remainder trust, except no charity is required. Now, most of our clients are charitable, they're just not 100% charitable. Okay, so with the Deferred Sales Trust, you can give it all to charity, or you can give 10% or 20 or 30 or 40 or 50, whatever you want. And the neat part is it's adjustable along the way. It's not, you set it and it's just, you can never change it. You can change it and adjust it along the way. They go for 10 years, and at the end of 10 years, you can renew for another 10 and renew for another 10, and just keep doing that. And then it can actually pass inside your living trust. It passes just like any other asset would pass in your living trust, and your kids can inherit your position. And they can do the same thing and keep this going for generations, okay? So that's the beauty of this. And the second part to this would be for any of your ultra high net worth clients, Parsa, who are worth more than 11 million single or 22 million married. And they're faced with what's called the estate tax, or known as the death tax. And this is one of the biggest challenges facing our ultra high net worth clients in the US, because if anything above that, it's going to be hit with a 40% estate tax. So let's use an example. Let's imagine it's a married couple and they're worth $52 million today. That first $22 million is going to be exempt. Okay, but imagine all 52 is inside the estate. Well, that leaves 30 million that's still inside the taxable estate. That's going to be hit with a 40% death tax. That's $12 million. 40% of 30 million is $12 million, unless they move the funds outside the taxable estate. So the problem is that the intent is to get it outside the taxable estate, but the other challenge to that is they hit this wall. And this wall is, I can't get the funds out fast enough. I've done family limited partnerships, I've done gifting to my kids, but I still have so much left in my taxable estate. The solution is the Deferred Sales Trust, and this is the beauty. At close of escrow, when you sell that asset or sell that business or that primary home, investment real estate to the trust, we can simultaneously move it outside the taxable estate. And what does that do? Well, that saves you 40% on whatever we got out. And that's really powerful.
Absolutely. I do a lot of estate planning for my higher net worth clients, and we oftentimes bring in, or most of the time, we bring in the accountant and the estate planning attorney, as well as the financial planner, to make sure that the estate plan makes sense. The beauty of working with capital gains tax solutions is that you guys have a team. So if a client wanted to use their own attorney and their own accountant, you guys work with them. It's beautiful, seamless transition and transaction. But if you don't have an estate planning attorney, or if you don't have your own accountant, the Capital Gains Tax Solutions has what you call a white glove service with their own in-house attorneys and accountants that can make this transition as smooth as possible.
Absolutely. And to that point, we want your trusted advisors to come in. We realize you're learning about us for the first time, you're meeting us for the first time, and this is likely your largest transaction and your family's net worth and your family's legacy. There's so much involved here, and it's a new tax strategy that we want to just take this slow. And this is the key, to pre-plan before you're even in escrow, before you're selling anything, before you're even really thinking about selling. It's never too early to connect with us and start to get educated. And the other part of it too is, if your CPA or tax attorney had known about it, they would have already told you about it. And there's no fault to them. They're just a specialist in different areas. And I liken it to the healthcare industry. If you have a general practitioner, they're still a doctor, they're still really smart, and they're helping you with, let's just say, a family general practitioner. He's helping you with your, the flu shots. He's helping you with general stuff that happens. But if you need surgery on, let's say, your knee, ACL surgery, or your shoulder, or let's just say brain surgery, you need something that's very, very specialized. That doctor is not going to be able to perform that because they haven't done the surgeries and they're not a specialist in that area. And this is really the shift a little bit, where you have to think of it like that. And not that we don't want their blessing to get this surgery, we want to bring them in, but they're not specialists. They haven't done the thousands of closes, right? They haven't done the thousands of surgeries. They haven't faced the IRS. So that's the part where we bring them in, we want to get their blessing, but realize they're not the specialists, we are. And with that, we don't charge anything at all unless the client closes the deal. So we basically have a no risk, no obligation until we don't get paid unless and if you close the deal. Meaning, we will educate you, your trusted advisors. We will map out the trust. We will map out the transaction. Consultant help any of the business brokers, M&A attorneys. And truly, it's a white glove. Like, we're right there every step of the way because we're experts in this. But if for some reason the deal doesn't close, if for some reason the buyer backs out, the lender won't lend, or you just decide not to use the trust, that's no problem. We do not have any obligation, no risk, no charge. We only charge if and when you close the deal.
Oh, that's fantastic. And I want to keep the video relatively short. I know this is a lot of brand new information for people viewing who may not have any exposure to tax law or to trusts. So if nothing else, what I want to do is just leave the information to reach out to either Brett of Capital Gains Tax Solutions or myself at Strand Life Financial. If you have any question, I know Brett has made himself extremely available for my clients and hopping on conference calls and really dissecting your individual plan, your 30, 45-minute call, just to kind of make sure that this is A, right for you, and B, if it is, move on to the next step. So Brett, thank you so much for your time. That was wonderful information. I'm hoping that the viewers really took some great notes and can walk away a little bit more educated. So thank you again.
Absolutely. And there's a gift too. If you connect with Parsa, we have a escape feeling trap from capital gains tax guide that you can look at, and also a deferred sales trust calculator. So connect with Parsa and we could do a quick review of your particular deal and give you a side-by-side comparison of pay the tax versus use the deferred sales trust. So don't hesitate to reach out to Parsa. We do those every single day, and at least you can get that initial map going for what it would look like for you. So reach out to Parsa and we can get that going.
Thanks so much, Brett. Have a great one. Take care.